morning. Today I want to talk about an option called strategy called the vertical call, and we'll discuss what is called the debit spread strategy, and it's supposed to be useful when you're mildly bullish about a stock. If you don't know about the call options, I would recommend that you watch some of my earlier videos. So go to the playlist option strategy at the Gore Associates and look for this video called stock option trading for the geeks. You do want to know about delta, theta, and vega, and also selling call stock options for additional income. So that's pretty much for the basics. So the way this option strategy is constructed, as I said, it is useful when you are, say, mildly bullish about something. And the advantages there are that it's a reduced premium to take on the position, and it's a debit, so it's called a debit strategy. And it has a limited, well-defined risk for taking the position, which is good. And I'll break it down and go into details. And it's pretty much theta time decay neutral. As you know, the options lose value over time, that's called the theta time decay. And this strategy is actually quite neutral for theta time decay. So take as an example, what we are going to do is construct this. So what you do is you would be buying one long call. So you, let's say in this case example I'm going to show is Tesla. So you would be buying a long call for 115 strike price for Tesla. At the same time, you would be selling a short call for 125 for Tesla. And let's take a look at the diagram as to how this works. Basically, we know that if the strike price of Tesla is greater than 115, the long call will keep making you profit and keep going on infinitely, right? So what we do is we think that in the next 2 weeks, the Tesla has an upside, but it will not go too much beyond $125. So what we do is we will be selling a short call for 125. So as you can see that the max profit is essentially capped at this, because since you sold a 125 short call, your profit will be capped at this expiration, this price value of 125. So the way this will work in this example is since you are buying a one long call, you will have to pay some premium. And the example I'm going to show, the premium would be 560. So you pay 560 for buying the long call. To sell the short call, you would be getting 229. So it's shown as negative because it will be credited to you. So the net premium you are actually going to pay is just 331. So that's why I called it's a reduced premium to take on the position, because you are basically willing to forego the profits in Tesla if Tesla is trading well above 125. So that is how it is constructed in this particular example. So your max profit will be in Tesla when with the as I said, at expiration it is greater than 125, and it's pretty easy to see how the profit comes up. Basically, profit is by this calculation you're seeing here. 125 is the, because it's already greater than 125, minus 115 times 100, because one call is equal to 100 shares, and the whatever premium you paid, which was in this case $331. So that would be your max profit of 669. And your max loss will occur if Tesla is trading at less than 115 at expiration. So this is essentially whatever premium you paid to enter the position. In this case, it is $331. 331 times 100. So you can see that. So that's how it is. Luckily, the brokers have made it easy to enter this, and I'll give you an example with the Streets Smart Edge from the Shop program. So let's take a look how you could do that. So basically, what you do is you could select a vertical call from there. So vertical call. I'm giving a width of 10 because it's I'm interested in doing it for 115 to 125 because I'm mildly bullish. I'm thinking that the Tesla price should be greater than 115, but not too much greater than 125. So that's where the option is. And as you can see, we'll be buying the option. Buy to option would be this much, 560. I'm taking the midpoint. Sell to option is 229 as we discussed. So this is the price, and actually the programs will actually calculate this value for it. You can see the max gain is 668, and break even is if the Tesla price at 118.32, you basically will have a break even, and your max loss is 332. And as you can easily see from this diagram that this is the curve. So this point where it says break even break even, that will be 118.32. So that's pretty much how you would enter a trade like this. And if you have any questions, feel free to enter it in the YouTube, and I will try to answer it. Thank you very much for your time, and you have a great day.